Let's continue. Now, we're excited to guide you through a key feature that stands at the heart of investment analysis, the DCF valuation. In our pursuit of precision and reliability, we meticulously try to follow the methodology championed by Professor Aswath Damodaran, a leading authority in valuation. His principles guide our approach, ensuring that every analysis we present is grounded in academic rigor and practical applicability. Let's embark on this insightful journey into the intrinsic value of Apple stock, equipped with one of the most respected methodologies in the field. The first question many of you might have is, what is DCF valuation? So let's put it in this way: DCF, or discounted cash flow valuation, is a method used to calculate a company's intrinsic value, which represents its true worth. This is done by discounting the company's future cash flows to their present value. Feeling confused? Don't worry, we've got you covered here at Amassing Investment. At the outset, you're presented with a choice between two DCF models, the free cash flow to firm and the excess return model. These models provide a foundation for our valuation, catering to different aspects of Apple's financial health. You can also select the valuation quarter, with options ranging from the current quarter to historical data, offering a comprehensive view of Apple's valuation over time. First up, the basic company facts section. Here, we detail the valuation quarter, Apple's country of incorporation, its operating currency, and the valuation currency, which is USD. This section also outlines Apple's sector and industry, providing a snapshot of its market environment. Next, we delve into current fundamental metrics, showcasing Apple's invested capital, trailing 12-month revenue, debt levels, levered beta, and more. These metrics are pivotal in understanding Apple's financial stance and market risk. Understanding Apple's past is key to forecasting its future. The historical valuation visualization offers a comprehensive look at Apple's valuation over time, enabling you to analyze trends and patterns in its financial performance. A cornerstone of our DCF valuation is the valuation assumptions section. Here, we meticulously forecast Apple's financial future, setting the stage for our intrinsic value calculation. This process is not just about numbers, it's about understanding the narrative behind Apple's growth, profitability, and risk. We start with revenue growth rates. Our models project these rates over the next 5 years, considering 3 scenarios: the best case, the base case, and the worst case. Each scenario reflects varying degrees of market optimism, based on Apple's historical performance and industry dynamics. For instance, in the best case, we anticipate market expansions or product innovations driving higher growth rates, whereas the worst case might factor in economic downturns or increased competition. Next, we assess Apple's operating margins. Similar to revenue growth, we forecast operating margins under the best, base, and worst case scenarios. These margins are crucial for understanding how efficiently Apple can convert sales into profits, a key determinant of its financial health. Our projections take into account Apple's cost management, pricing strategies, and the competitive landscape. Equally important are our assumptions about Apple's cost of capital and the risk-free rate, which we kept constant across all scenarios for simplicity. The cost of capital reflects the return expected by investors, encompassing both debt and equity financing costs. It's a pivotal rate, discounting future cash flows to present value and encapsulating the risk inherent in investing in Apple. The risk-free rate, usually tied to government securities, provides a benchmark for evaluating investment risk. Our assumptions are not plucked from thin air, they are grounded in rigorous analysis. Leveraging advanced AI and ML algorithms, we analyze Apple's past performance and industry norms to craft our forecasts. This approach ensures that our assumptions are realistic, reflective of market conditions, and capable of adapting to changing economic landscapes. The valuation notes provide a narrative on expected revenues, margins, and the rationale behind our assumptions. This section ensures you understand the foundation of our valuation model. Now, let's dive deeper into the core of our valuation analysis, the valuation output. This pivotal section is where the theoretical meets the practical, transforming our assumptions and models into tangible estimates of Apple's worth. At the click of a button, you can choose among best, base, or worst-case scenarios, tailoring the analysis to your outlook on Apple's future. Instantly, the estimated value per share is revealed, alongside an assessment of whether Apple is currently undervalued or overvalued compared to its market price. This immediate insight is invaluable, providing a clear indication of investment potential. But we don't stop at surface-level analysis. The essence of our DCF model is detailed in the subsequent cash flow table. This table isn't just numbers, it's a narrative of Apple's financial journey over the next decade. You'll see columns representing each year's forecast, culminating in the all-important terminal value, the crux of our valuation. The journey begins with the revenue growth rate, setting the stage for expected revenues. Following this, we examine the operating margin, giving us a glimpse into Apple's profitability after covering operating expenses. Next, we account for taxes, leading us to after-tax operating income, a crucial bottom-line metric. Growth requires investment, and our model acknowledges this through the reinvestment row. It quantifies Apple's commitment to future expansion, subtracting this from the after-tax operating income to arrive at the free cash flow to firm, FCFF. This FCFF is the lifeblood of our valuation, representing the cash available to all capital providers after accounting for the costs to maintain and grow the business. Each FCFF is then discounted back to its present value using the assumed cost of capital, reflecting the risk and time value of money. This process crystallizes our understanding of what Apple's future cash flows are worth today. With the present value of FCFF in hand, we turn our attention to the value of the operating asset. But our interest lies in equity. So, we adjust for debt and minority interest, add back cash, and voila, the value of equity in common stock emerges. Dividing this by the total shares outstanding yields the estimated value per share, or the intrinsic value of Apple in USD. If a stock's financial reports are in a currency other than USD, we convert these figures to the respective local currency to facilitate easy comparison between the estimated and current prices. This comprehensive section is not just numbers on a page, it's a tool for making informed investment decisions. Whether you're assessing Apple's stock for potential investment or seeking to understand the intricacies of DCF valuation, this output provides a clear, actionable valuation, underpinned by rigorous analysis and transparent assumptions. For those who prefer visuals, our table visualization charts transform the valuation data into intuitive bar charts. This alternative presentation helps you grasp the valuation nuances without diving deep into the tables. Moving on, understanding how Apple earns its revenue is crucial. The current revenue structure breaks down Apple's revenue by segment and geographical region, offering insights into its business operations and market reach. As we approach the finale of our Apple DCF valuation journey, we arrive at a crucial juncture, the valuation diagnostic. This segment is essential in validating the robustness of our valuation model and ensuring the assumptions made reflect a realistic and defensible forecast of Apple's future. Valuation, by its nature, involves assumptions about the future, a realm filled with uncertainties. The valuation diagnostic serves as our litmus test, scrutinizing the terminal value's alignment with industry standards and Apple's projected market position. This is where we affirm the credibility of our valuation conclusions. The terminal value represents the expected value of Apple's cash flows beyond the explicit forecast period, extending into perpetuity. However, its calculation is predicated on the assumption that Apple's future growth will eventually stabilize. Our diagnostic framework evaluates this assumption through a comparative lens, comparing Apple's current revenue weightage in its industry against its projected terminal weightage. This analysis adheres to a set of criteria designed to reflect realistic growth expectations based on Apple's market share and industry dynamics. For instance, if a company's current revenue weightage falls between 0 to 5%, the terminal weightage should not exceed 20%. This sliding scale progresses to higher thresholds as the company's initial weightage increases, ensuring that our terminal value assumptions remain grounded in economic reality, thereby preventing overly optimistic projections. Why is this important? Because it safeguards your investment decisions against the pitfalls of speculative forecasting. By applying these criteria, we ensure that our valuation reflects a balance between Apple's growth prospects and the inherent limitations of market saturation and competitive pressures. And that concludes our walkthrough of the Apple's DCF valuation using the FCFF model. Through this detailed examination, we aim to empower you with the knowledge to understand the intrinsic value of companies like Apple. Remember, fundamental investing is all about making informed decisions, and we're here to provide the insights you need. Next, we'll explore another valuation model, the excess return model or ERM. Stay tuned as we dive into this. You might wonder why introduce another valuation model like the excess return model or ERM when we have FCFF? It's complex, but in essence, for financial service firms where defining total capital is challenging, focusing on equity through the ERM makes more sense. This model calculates a firm's equity value by adding the equity in current investments to the expected excess returns from these and future investments. The key feature of the ERM is its emphasis on excess returns. Essentially, a firm earning just the market rate of return on equity should see its market value match the invested equity. If the return is below market rate, the market value will fall below the invested equity. Importantly, the ERM also accounts for expected future investments, requiring analysts to predict both the direction of these investments and their potential returns. Since our focus is on financial services firms, let's examine the ERM model for Bank of America. Assuming you're familiar with the FCFF model for Apple, we'll skip over the common sections in our discussion. So, let's directly jump to the valuation assumption section, where we use net margin forecasts instead of operating margin, and cost of equity replaces cost of capital since we are focusing solely on equity. All the forecast methods remain the same as discussed in the FCFF model. Moving on to the valuation output table, it begins with the revenue growth rate and its corresponding revenue, followed by net margin and its resulting net income. Next, we calculate equity cost from the cost of equity. By subtracting equity cost from net income, we arrive at our excess equity return, the cornerstone of the excess return model, ERM. This excess equity return is discounted to its present value using the cost of equity. Following this, we examine the dividend payout to determine dividends paid and retained earnings. These retained earnings are added to the current equity to get the future equity book value, which thereby used to calculate the total equity cost from the cost of equity. The table also includes rows for return on equity, ROE, and price targets. From this table, we calculate the value of equity in common stock, which, when divided by the total shares outstanding, provides the estimated value per share or the company's intrinsic value in USD. If the local currency differs from USD, the estimated value per share is also provided in the local currency. The remainder of the section is identical to the previously explained FCFF model. This marks the end of our detailed guide on valuing Bank of America using the excess return model, ERM, within the DCF framework. Our goal is to equip you with the necessary insights to grasp the intrinsic value of companies such as BAC. Concluding, the essence of investing lies in continuous learning and informed decision-making. May your investment journey be guided by knowledge and prudence.